And then, of course, when. In other words, when something bad goes wrong, can you handle it financially? Or when something happens in the future, like retirement or education funding, are you on track for that?
Welcome to What's the Alternative? We have a great episode for you today. I'm actually quite excited about it because this is somebody that I have looked up to for a long time, somebody who has built what I'm hoping to build here with Bonrian and has a lot of experience understanding how to build and scale businesses for financial advisors like you and our audience. And I think that this would be a very valuable opportunity to hear about a tool that you as advisors can use that can help you plan and allocate to alts in a scalable way and understand how they fit into client portfolios, which is part of what we're trying to solve for too. So with that, I'd like to introduce Adam Holt. He has been a financial advisor for over 25 years, during which time he has helped build and manage his wealth management firm to over $1.2 billion in assets under management. He is known for early adoption of technology and to build trend-setting client experiences. And this is what led him to found AssetMap, which is a financial technology firm dedicated to creating an engaging visual communication tools used throughout the customer and advisor world, and now has thousands of advisors worldwide that use AssetMap and supports over 1 million consumers. So with that, welcome, Adam.
Thank you, Shana. Good to see you.
Very good to see you as well. Last time I kind of saw you, but you were on Zoom and not in the room when I was at the Founders Chair back in December. But it's great to see you and talk about your journey. As we mentioned right before we went live, one of the reasons I'm excited to have you on the show is to do something a little different than what we've typically done, which is kind of talk about the entrepreneurial journey and finding and building solutions for advisors like the ones that listen to our podcast. Because I used to be an advisor and you are an advisor. And I think that really brings experience into how we think about building these solutions for advisors. That's unique. And so I'd love to just start there. What kind of pain points were you identifying as an advisor that made you think, I have a better solution for this than what's out there, and hence to launch AssetMap?
I don't know. Some things I think probably, and you can relate to this, we're thinking we're a glutton for punishment, right? We feel like we have to convince people that they maybe should go about it differently, right? We're going to have to deal with change management. But I think for us, and it probably almost like your own process at Bonrian is once you get the feedback from the customer that they really appreciate this experience over prior experiences, I think that gives you the validation. For us, a long time ago, I say long time ago because I was just talking about this recently. My original IP goes back to 2002 and 2004. I'm like, that's crazy. That's over 20 years. And what I realized back then is I personally had a hard time keeping it straight about all the clients' complexity, all the stuff that was going on in their lives, not just the people and the trusts that they had accumulated and these entities that they had invested in, but all the individuals that were codependent, generation 0, generation 3, generation 2. So for high net worth clients, I think what tends to cause paralysis and an undermanagement or maybe even mismanagement is the complexity of it all. And so my goal was to try to get it all on one page back in the old 8.5 by 11 days where everything had to be printed. I started drawing out using engineering tools. Here's your life on one page. And people were just so happy to finally see their life differently, where they could ask questions and I could ask questions. And that process, which became AssetMap, actually I started using in my own practice back when we were broker-dealer days. And in 2006, got a compliance approved, and I tripled my revenue in that year. And then I tripled it again and again. So 3 years in a row, and finally realized, you know what, Shana, this was investable. So I invested my money in building a technology platform for myself, and scaled it in my firm, which became 25 people here in Philadelphia. And then I showed it on a conference stage in 2012, and all of a sudden was a surprise that 20 advisors, top producers at the time, came to me and said, "Hey, can I use this?" And now you look at it, we have almost 7,000 of those advisors literally around the world. So in a sense, I think invention is, necessity is the mother of invention. I mean, the reality is I needed to solve a problem for myself. Turns out most of us in the professional world have the same problem, just explaining complexity.
And I think that's really interesting because, you know, I think whenever you look at technology that's aimed at a certain market, you have to think about who was the person who launched the product and what was the problem that they were trying to solve. Because as you just pointed out, it's almost always comes from a problem that was being faced by the founder. It
Totally.
doesn't come out of nowhere. So in your case, you were facing this problem. In my case with Bonran, I was personally facing this problem. I was working with advisors who wanted to build alt platforms, and I was going and looking at these legacy players and trying to like mishmash something together that would work, and realizing that they weren't intended to be a solution for advisor problems. They were meant to be a solution for distribution problems for asset managers. So they were coming at it differently. And that's why I was having such a hard time making it work for the problems that I was seeing as in the advisor seat. And it sounds like that's kind of what you face too, because it's not as if these tools didn't exist previously. They just didn't exist in the manner that they did. And that's kind of the beauty of what you've done.
I think we finally figured out actually what the problem really is, Shana. That is, most advisors actually, the relevance that we provide with the client is actually in the advice engagement side. And what that means to me is when I'm talking to my clients and I'm applying the original AI, which is advisor intelligence, to their life in real time, that's when I earn all my trust, my confidence, my relationship currency, my loyalty. And so it's really helping them deal with big problems and helping them understand the problems they don't see. And that experience is really where I think humans still have a relevance in this kind of tech-enabled future of finance, is really to be a sounding board, to be a guide, to be an advocate, to be a steward for the client's best interests, whether they're financial, whether they're almost emotional, whether they're legacy, or whether they're values-based. And I think that what we're really doing today is we're really actually just enabling that conversation by just showing the facts in front of them in a unique visual way. And it took us a long time to realize that that's why it was working, right? We just thought it was because I just needed to understand the complexity. It turned out that the clients needed to understand their own life and get permission to ask questions in a way that was going to be helpful to them. So I think the irony behind all the things that we create, when they work, we don't always know why they're working. But if we continue to get the positive feedback that it's actually making a difference in the results and the outcomes, there's something there. We should keep exploring it.
It's interesting when you say that because one of the things, I did a podcast with you 2 years ago at Wealth Management Edge, as you recall, and we were talking about alts as a business development tool. And, I think what you're saying right there about the relationship and having this way to connect with the client is at the core of what we do too, because we view alts as a business development tool in a way to help your clients invest in a way that aligns with their personal values and passions. And alts is really the place you can do a lot of that. Traditional public investing, it's not as easy to make those connections. But to your point, being able to visualize, that's actually why we're doing a client blueprint project where we're helping advisors take kind of an inventory of the attributes of their underlying clients, creating personas to help them understand how to communicate based on the attributes of their underlying client base, and then what those types of personas are attracted to as an investment, and then using AI to help create matching scores that will allow the advisor to find the ideas. But I think your point is clear. As an advisor, and as a former advisor myself, one of the things that you understand is that the advisor's job isn't to run investment portfolios per se, or to sell investment product so much as it's to solve long-term planning problems and goal set for clients and understand what drives them and help them understand their own behavioral cues in order to have the best plan in place to help them reach those goals. And we spend so much time talking about, did I beat the S&P 500? Did I do that? Did I do this? That we lose track of what the actual reason why that person is coming to us. And it's not because we can give them amazing investment results. Now, they will fire us if we don't give them at least market returns or help them reach their goals, keep them on track. But they aren't going to give us a reward of some sort because we crushed the S&P 500. It's just not what we're meant to be doing. So as you think about kind of the key things that helped you be successful and building Asset Map and the feedback you got from advisors, how is it that you were able to incorporate into your solution ways for the advisor to get to know their client better and to build on that relationship and subsequently grow their business?
That's a great question. I think in the early days, the Asset Map was an attempt to just say, hey, I listen to you. Let me prove to you that I listen to you. Here's all the people that are involved in your family with whom you have financial relationship or entities. Here's the income sources. Here's the assets controlled by, like, who controls them, not just owns them, but who controls the decisions around them. Here's your joint instruments. Here's your insurances. Here's your liabilities. Here's everything, like a treasure map on one page. We can all read it. It's technical, but it's also consumable. And I thought that for many years, that was really, we never had to do much more than that, because if you could just prove to the client you actually listened and now got permission to explore and fix and fill and, bring in other expertise, legal, tax, insurance, investment, like you can have a collaborative discussion, which is really where we wanted to live. Our highest revenue producing activity was actually meeting with people and helping them make decisions. Like, everything else is just the business of executing that. And for me personally, I just wanted to spend all my time in that mode and delegate everything else. And that was really successful. I actually sold my securities firm in 19 because I needed to raise money for Asset Map as it got bigger and bigger. And really, I needed to expand beyond my own capacity to finance it. But I think even today, I've realized, I mentioned before, conversational financial planning is really, I think, the future of the human role in financial planning, because I think AI and these next generation tools are going to really take all the analytical function off our plates, right? I don't think I'm going to have to do a retirement analysis for you. I'm just going to run an AI template and it's going to tell me how much I should save. I don't think you're going to trust it just because you trust the math or you don't. So that's how I tend to think that the market's going. It's going to put a lot more pressure on the humans. So for us at Asset Map, we're focusing on really the core questions, which is who's involved. And we built this whole like family tree visualization that advisors can now use to talk about multi-generations, so forth. Where's all your finances? Why? What are your priorities listed by, let's reprioritize your categories of what you really care about live, interactively. And then, of course, when. In other words, when something bad goes wrong, can you handle it financially? Or when something happens in the future, like retirement or education funding, are you on track for that? And it turns out that the advisor is really the how. So if you think about that, that's the who, what, why, when, and a how. If we can answer that as financial advisors and visualize and facilitate that conversation, we get huge meaning and relationship gains that we, would typically take 5-6 meetings or years to develop. So that's really where you're going to see us focus as a platform. And whether a client includes alts or private interests or venture or private equity or a real estate deal I brought with my brother because, we like real estate on the side, those things should all be accessible and also handleable by your technology stack, which unfortunately most of it's not. As we've struggled for years to have alts be represented in a reasonable way, yet all our high net worth clients have alts and have had them for 50 years. So it's not so alt, is it? I mean, today this is becoming mainstream, and it's nice to see the tech is finally catching up.
Well, we're trying. And I think what you've kind of touched on there kind of speaks to something that I think is often overlooked, which is, there have been surveys done by large institutions asking clients of advisors, if they felt their advisor knew them and asking them questions about their relationship with their advisor. And the vast majority of these surveys show time and time again that the average client doesn't feel like their advisor has done the things to help them understand them individually and their needs. And the tools that are out there don't really facilitate that. And obviously Asset Map does. What we do here at Bonran is really focused on that, because to your point, once a client feels connected with their advisor, like their advisor understands them and their goals and their needs, that client is not going anywhere, no matter what. And so retention becomes much higher under those circumstances. But I think also to your point is that as an advisor, that's the job, right? And so if you don't have time to have those meetings and have those discussions and have some roadmap to help you have those discussions, then you're just kind of facilitating and trying to figure out the how and not get the answers to all the other questions, as you pointed out.
Yeah, I mean, clearly, I believe that's all true, and I think for most of the advisors that are probably listening to this, thinking they've got a whole suite of tools and that meet different needs for different clients and different episodic kind of advice strategies, or they're using a very robust financial planning tool. I think that those tools are all getting pushed into the back office. We need to do more participation with our clients, less presentation. And over the years, we were always trying to show our clients, listen, look how smart we are. And that's why we deserve the credibility to basically be responsible for managing the capital, which is actually where I get monetized anyway. So effectively, this is a sales enablement process. And I think financial planning as a great example, right? Because most of us are comprehensive, we're holistic, all these great words that show that we're thinking about the bigger strategy and tactics. But at the same time, the client's generally lost, right? The client wants to know, am I okay? And I'm probably going to trust you. And now can you actually empower me to help me understand my own life better? And for that, I will give you relationship currency. For that, I will refer people to you. For that, I will tell my kids to make sure that when I go, you're still involved. And because a lot of advisors, I think, are not really thinking about what their client's going to look like in the next 10, 15 years, they run the risk of keep running the same exact play they've run for 100 years, expecting the same exact result. And I think we're finally at the precipice of this tipping point where it's not going to work. You can't bring the same old SMA. You cannot bring the same old index fund strategy, charge 80 basis points or more, and then expect that the next generation is going to value that at all. So, what are you doing different, and how are you really shepherding and really, being a steward for the client's capital over the next 30, 40 years, even to the point of that you have actually succession and tech that's going to engage them and empower them.
Now, does Asset Map look at helping the advisor facilitate discussions beyond just the core client and talk to their children and find ways to kind of bring those folks in? And totally. If so, how did you kind of come to that, and how did you incorporate that into your solution?
Well, look, the answer is yes, it totally does. And the way that it does that is a couplefold. The relationship map that I mentioned, which is that real whoosh, can I show you a visual a family tree or any kind of mind mapping diagram that explains the people that are financially interdependent on you? In other words, typically my children, my partner, my spouse, maybe my business partners. There's financial interdependencies we need to pay attention to. And then there's also generation zero, usually our parents of the clients that we have, that there's going to be some either financial obligation to care for them or some financial obligation to manage their estate and distribute it amongst the next generation and or receive it, right? There's a lot of complexity, especially given that we think in the sandwich generation, many of the clients that we have still have living parents for which there will be financial obligation and emotional drain associated with caretaking, long-term care, and all this other stuff. And we can't ignore that stuff when we talk to our existing clients and we tell them, listen, you need to do an estate plan for you to protect your children. They're going to be likely the beneficiary of an estate plan or no plan that their parents had. And so what we do is we actually create a map that shows all those generations of our clients in the middle and say, what is the plan? What is the parent's plan? Is there complexity? Is there health? Is there wealth? Do I have to bring ideas to the table that you didn't ask me to bring in? Because I know from experience, if your parents go through the ringer, it's going to be a huge stressor on you. And should I not have brought those ideas to the table? So we use Asset Map to bring and tee up the question of what is the plan to maximize the wealth transfer, or if that's the opportunity, between these multiple generations. And can we just build your mom and dad a treasure map? Can we build them an asset map? It takes 15 minutes on your phone. Let's just make sure everybody knows where everything is. They're not going to sit down for an e-money, God bless them. But I know I'm not going to get Nana and Pop Up to do an e-money. But can I get them to do an asset map? I think so. And so, yes, we've really focused on that and delivering a client portal to all three generations that need to have access. So I think you're seeing, can we provide ways and utility for an advisor to engage multiple generations and build what I call relationship currency amongst all of them so that they're worthy of keeping that relationship at the next transition?
Absolutely. And that's so important. And I think most advisors forget that. And as a woman, there's plenty of studies that show that once the husband dies, the wife almost certainly leaves the advisor.
That's right.
And that is continues to be an ongoing trend. So uh, this is an issue that advisors should be aware of, and having a solution like what Asset Map provides
Hmm.
solves in many ways to make sure that the spouse, the partner, the children, the parents are all part of the discussion, so
Hmm.
that for generations you can continue to be the financial advisor and have those relationships. I want to flip the switch just a little bit,
Okay.
and I want to talk about your entrepreneurial journey.
Hmm.
I think if you think about most independent RAs, in a way, it's an entrepreneurial journey for them as well. Maybe not startup technology, kind of backed by investors, kind of thing. But
Hmm.
I'd like to hear a little bit more about your entrepreneurial journey in building Asset Map, and sort of what are the hurdles you faced over time and how you kind of worked through them. And then more importantly, now that you're kind of at a point where you're scaled and you're really established, of course, in these worlds, you're never truly really established in technology. You can go away any second if some
Yep.
other player comes in with a better solution. So you got to be on your toes. But with that
Yeah.
said, you also occasionally invest in other wealth tech kind of
Mhm.
startups. And as you evaluate those, I know many of our advisors in our audience work at firms where they occasionally look at potential partners that are really interesting and intriguing, and think, well, what if my firm invested in them? How can that, be something that can add value for our clients and the like? How do you evaluate other things with the mindset of your own journey?
That's interesting. So, I've been lucky enough to have access, as you know, private equity, alts, etc., direct investments. It actually comes down to access. And I think in many ways, that's where an advisor can add a level of, I'm going to call it exclusivity, but also, I'm not sure what the quite right word is, but there's a unique value proposition that an advisor who offers alternatives has over someone who's offering marketable securities. And that is, you can get me in the club. You can get me in the door to this special thing. I just got a call the other day. Someone said, "Hey, do you want access to SpaceX?" And I'm sure there's lots of ways to get it, but because I got that call, I might be, oh, okay, I'm inclined. Maybe I want to do it. So I think that client advisors who offer those kind of door opening opportunities for clients, I think clients really appreciate that. With respect to my own investments in alternatives, it came because, like you, I'm very involved in the fintech world, and I come across deals and people reach out to me. And it's actually the same thing that I used in my own journey when I decided to go the route of OPM, other people's money, and not self finance and bootstrap. Which every company gets to a point where you're thinking, okay, I'm seriously over leveraged here. Like I might own at the cap table, but I'm like, my whole family owns me, because now I've made a huge investment in a single security, which we all know from financial advice is it's a risky proposition, right? Especially illiquid. And I think for me, when I first did that, I didn't know what I was doing. I'm always fumbling forward. I'm trying to figure it out as I go along. I was very blessed in a way that the way it turned out in our Series B, after we had taken some small institutional money, I had to do a significant raise to decide, okay, what am I going to be when I grow up? And I actually had we had as many as 20 offers. This was back in 2022, 21, 22. It was a crazy time to raise money. And as a CEO at the time, it was a little overwhelming, right? Everybody's saying that you're worth so much. Interest rates were really low. It was a crazy tech time. We were seeing exits of major companies, and I got disillusioned as to what valuation really was all about. And I think that's all come back to kind of to roost. But I realized how little I knew. Even going back to the very beginning days, I spent way too much money, like millions of dollars, building the wrong tech. And I didn't have the right people involved in the company early because I was just trying to go it alone. I didn't want anybody's opinion. I'm like, we're doing it my way, but I didn't know what I was really doing. So I spent a lot. I call it my second MBA, which was basically a waste of money. And I'm sure you can relate to this. But I think entrepreneurs that have, if you've got the right idea and the concept, and you've got the funding and the willingness to put your family through the rigor of actually being this kind of startup person. And you keep fighting. Sometimes it works, and most of the time it doesn't. I think that the takeaway from that whole tirade was that at the end of the day, despite getting venture offers and so forth, I wound up funding the entirety of my Series B with network. I wound up picking up the phone and saying, I don't want to deal with these guys. They're really trying to take advantage of me now, and I don't like it. And it's not the way I want to write my culture. What should I do? And they said, Adam, I'll write you a check. How much you want? 100 grand. And of course, to raise millions of dollars at 100 to $200,000 is not an easy thing, but it was probably the best outcome we could have ever received. So we wound up actually getting 41 investors in that round, all from industry, all fintech CEOs. And I realized something back then, which is, wow, we could actually crowdsource this if you have the right people. And I think that's a newer model for most of us that are starting out. So I would really encourage people to consider the people who know your product best, including your existing customers, probably want access to be part of the cap table and join the ride with you. If they know the impact that your product makes. And I think 27 of them are actual customers. So that's a bit of a reveal. I've never told anybody that, but that I think for those of you that are in that world or want to give inside access to different opportunities, it's a really great way to buy what you know and are using and paying for today.
Yeah, I think that's really important advice, as I'm personally kind of discovering on my own as we speak. I didn't start fundraising till after SPV went down, and that became a significantly more difficult environment to raise money in. But to your point, I found that those venture capitalists, those private equity firms, for the most part, don't understand the space at all. And they actually are not the greatest partners in the world, to your point. And it's me picking up the phone and calling other folks in the industry that have had exits or have had success with their own products, to your point, fintech and otherwise, has been where I've gotten people saying, yeah, no, I totally understand this problem. I totally understand what you're doing. And again, to your point, our only venture backer to date is a firm called Kinetic Ventures. And Brad Zapp, who is the founder of Kinetic Ventures, started his career as a financial advisor. And so he immediately understood what we were doing. And to your point, he's also a customer because he needed the service. And then he saw the value as an investor. And it's exactly what I think a lot of people miss. They get caught up in the sexiness of being able to raise capital from venture and the big venture names that are out there, that they lose focus on the fact that these folks can be assets to you if they're the right investors. It's not just about raising capital. It's about raising capital from the people who can help you strategically. And some founders probably don't need 1 million strategic investors, but having a few, I think, is incredibly important to being able to have success. And you said something really interesting. I'd love to hear if you have any anecdotal stories as it relates to this. But I heard somebody say once that the difference between startups that make it and startups that don't are that the startups that make it, every time they hit any sort of like roadblock, and every startup, will, no matter what, will hit some point in time where they have a cash flow issue, they need some sort of bridge, they miss payroll. It happens to every single one. This is not unique. And if you're a startup that hasn't experienced it yet, just wait. You will, because it happens. But I think what I heard was the difference between the startups that make it and the startups that don't are the ones that work through and push through that hard part and don't just say, okay, you know what, I can't do this too hard, I give up. And are willing to not pay themselves for a while and willing to deal with the pain that comes with that because they have the right idea and just the goal is just to push through it. Do you think that that's true? And if so, do you have any anecdotal stories of where you may have had one of those moments that you were able to push through?
Yeah, I mean, I'm listening to what you said. It's been like on this journey. I think of it, actually, we're coming up in March, so we joke that this is maybe our 12th year legit anniversary, but of course it's been longer than that. I just told you that. To tell you that it's not been a bumpy road would be a total misstatement of that. But I think the CEO founder version has to be, I don't see the bumps. I feel the bumps, but I don't see the bumps as barriers that are going to stop me. Now, that being said, I have invested in companies where the CEO probably needed to have an exit plan or a kill criteria, a moment before which they said, you know what, I think it's time to call it, right? A fold strategy, which is never fun and always stinks. And there's other times when you need a no, I'm all in, and I'm all in again, and I'm all in a third time, because you know how to read your cards as opposed to just have vision. And that's always the rub, which is, interestingly enough, before, in your prior comment, private equity and venture have a very clear formula that they know they can take X and turn it into 3X. And it might require doing things that a founder-led team is not necessarily comfortable or used to or experienced doing. And that change is always difficult, by the way. But whereas customers are like, listen, keep doing what you're already doing. I love what you're doing. And they're literally giving you validation to, I'm going to invest in you because I don't want you to change the product. In fact, it'd be great if you could also do this and solve this other problem so I can save that. So I think it is interesting, those two different phases, but the venture and PE definitely has a role for a time at life in the business. And they will see sometimes more of the bumps that a founder or a founder-led team will see, and they will be scared by them because those are potentially disruptive events, right? That's, oh, we're not going to turn X into 3X because we don't want to have to deal with it, or we don't think the founder team knows how to deal with it. So those are kind of just experiences that I've had. I think, that fundraising experience back in 2022 I think I've told that story to many other founders in private rooms about that experience, to show how difficult that can be when all of a sudden you commit to growing the company and the venture team says, yeah, we're not coming to the table on the closing day. And you're like, why? Because of some condition you couldn't control or they couldn't control, and you got to scramble. And you're going to say, well, I'm not failing, so I'm going to go raise the money myself. That was definitely an interesting 6 months. So, but as I said before, I think that it wound up actually being a swan song in a sense. It was the right story for us that aligned our values and people.
Yeah, you said something there which I think is really interesting, and I think as
Cool.
potentially people evaluate startups and founders. You said sometimes they need to have a kill switch. But what do you think is really the 2 or 3 things that if a startup kind of faces it, you kind of have to consider that kill switch? Is it, because I got to think it's not necessarily capital per se. It has more to do with market penetration and things of that nature. Would that be accurate? And if so, can you elaborate?
It's a good question. I don't profess to be an expert at the kill criteria because I tend to be a grit believer, not a quit believer. And if you know what I'm talking about out there, there's a book written by Duckworth called Grit, which is very popular. And there's also a book written by, of course, now I'm going to Federer, called Quit by Annie Duke. And the contrast of those two. And Annie Duke talks about, she was a very famous poker player. She talks about knowing what the criteria is. And one of the venture, there's a chapter in there, I can't remember which one it is, so please look it up, where she talks about modeling one of the top venture investors ever who helped founders like ourselves ask ourselves, what is the criteria at which time, logically, if I don't hit this, it doesn't justify moving forward. And what is that? And then let's say what that is in 3 months, in 6 months, in a year. If I don't achieve X, then I will put this back on the agenda for potentially killing it. Maybe not just committing, but I might put it on the agenda so that I'm forced to be real with myself. Well, maybe it's a family situation, right? If we can't generate X number of revenue, I can't pay the mortgage, and the bank is going to make the kill switch for me. So it's really important for us to prove to also other investors that we can make good capital decisions despite our emotional connection to this project, because that's what investors are actually investing in. They're really giving you that, just like in a financial advice, they're giving you the capital to put it in with a good manager or manage it yourself so that you can be a good steward of this money, not so that you can just wing it and be like, okay, whatever happens, happens. Like, if it's true risk capital, okay. But in most cases, I think most investors want their money back. So I think it's incumbent upon a founder who is going to say, yes, I'm going to take on capital, other people's real hard-earned capital after tax, I'm going to make good decisions for the benefit of the firm, not just my vision. And that's a hard thing to do. I have to tell you, I had to bring in a COO to basically be an attorney who's trained as an attorney, to basically be my, my bullshit caller. When like, yeah, that's nice, Adam, but we can't afford it. So,
Right. Yeah, I know. I had a conversation with Tyrone Ross recently where he was like, yeah, he was a little bit of the truth serum that I needed to hear in the moment. Because other founders are always going to say to you, like, what you're doing is borderline, irresponsible, even though in your mind you're thinking like, oh, I don't, I'm looking at what I spend my money on, and it's the bare necessities, but maybe I am paying my employees a little too much. Maybe I am offering a little too much benefit wise. Maybe I need to think about, those things and determining how to balance it to ensure that we can be successful, but also a good steward of capital, as you put. And I think that those are all things we have to deal with for sure, because you want to be competitive, and so you got to have good people. But then there's like this fine line between you're not the big guy, so you can't think of yourself as competing for those same people to help you succeed. And that can be a hard pill to swallow sometimes, especially in our business, because like everybody who has any talent is super expensive. And that's just the nature of the business. But I think it's a valuable piece of advice in that respect. And I think that anybody who's considering starting a business or investing in a startup needs to consider the founder. And I have read that book, Grit, and I love it. I consider myself a gritty person. I look at it as a founder, just candidly, is, are we growing a business? Is the pipeline really robust? And is lack of capital the reason I'm not able to close things as quickly or move as quickly? Or is lack of capital the only thing that's keeping me alive right now? Is what capital I have, I'm not growing. I'm not bringing in new revenue. I don't have a pipeline. I'm losing clients, not gaining clients. I think for me, that's kind of how I look at it. As long as we continue to make strides and evolve and bring in new business and have a robust pipeline, lack of capital can be painful, but it's not going to make or break us, because we have things moving. But if it was the other way around, I'd probably feel differently. I think ultimately that's what it comes down to. Do you have a product people want? Is the reason that you're not growing the way you want to because you're unable to meet up with the demand for your product? Or is it because there is no demand for your product and you're basically just blowing through capital to keep yourself alive?
Totally. I mean, look, product market fit is a term that I think everyone needs to really pay attention to. Even if you're a financial advisor, do you actually have product market fit? Why is that important? Because product market fit can be scaled. If it turns out that you're the product, right? Everybody's buying you as a financial advisor. One might argue that you've figured out your own personal product market fit, but are you scalable? Maybe not. And I think the same thing is true for our technology solutions or any kind of service or product that you're making today, is getting to that true product market fit where the founder can kind of step away and say, this thing actually serves a problem and doesn't really require me to be the kind of linchpin of everything. And that's what I think we're all trying to get to. In the early days, our employees believe in us, believe in the leadership, believe in the vision, maybe even have equity, and they conceivably are underpaid for their time in real terms, but in long-term benefit, they get career advancement and experience and all this other stuff that is immeasurable. That goes for a certain period of time until everyone needs to get paid and rewarded. And the challenges change, I think, as you evolve as a company. But I do think for the startups that I've invested in and that I'm coaching, getting to that product market fit is really the most important, even if you're losing money early on, because if you can prove that customers are there, the market is big enough, and that it's really just a matter of fixing a couple of things, those are all growing pains I think we all have. So that should be the most important thing to keep important, is the most important thing.
And I think, I'm sure you found this too. Sometimes your product market fit is something you never expected.
Yeah.
Right. People come to you that you never expected to come to you and show you that your product has a market fit beyond what you even thought. And I always find that interesting as a founder when those moments hit where you're like, oh, wait a second. Now I like they help me understand my product market fit better than I thought I understood it to begin with.
And communicate it.
Well, exactly. And exactly that, and be able to communicate it, which is the key. So, I know we're coming up on time and I know you're busy, so I don't want to take up too much
We're
more of your time. But I'd love to kind of hear when you think about the way that Asset Map solves for advisors and selfishly how that connects with alternatives and the way that advisors can use Asset Map in their alternative journey. How does that work and how does that fit? Because not many solutions actually incorporate alternatives into the way that they work with the advisor.
Well, I think part of this came from my perspective on alts over any financial instrument was really not from a US financial advisor centric experience. It was from a global capital control perspective. That was the benefit of working with ultra high net worth billionaires who were multinational, and they didn't think just in, do I have a residence and a REIT and some private equity fund. They actually made direct investments in these things, and we had to illustrate them as a bucket of capital that was allocated. In other words, this is a bucket of your liquidity. This is your marketable securities. This is an investment you made in this limited partnership that's split interest inside of a trust, and I need to represent that just as equally as I would represent a life insurance policy. That's a financial decision with capital allocated to it. And the only question I really wanted to ever ask was, is this a capital investment intentional or not? Does it serve you or not? Is it intentional or not? And now there's all these justifications for why we're doing it. Okay. Cash flow, tax advantage, illiquidity, whatever. Okay. All the things, all the reasons. But I wanted a way to challenge every status quo, which is, does this deserve to be here? Does it deserve to be there? And that means we had to be able to handle any kind of financial instrument. It just happens that alts or illiquid assets or direct investments just fell into the category. Like, I own a business, I own this company, I own stock, I own restricted stock options. It doesn't really matter. And so we shouldn't create boundaries that certain types of financial instruments should exist on a map, and certain. No, everything's welcome. Because the next investment, crypto, didn't really exist at the time when it fits perfectly, right? Okay, crypto, it's a financial instrument, right? It's just a choice to put capital there. So I think where in the past we didn't think like that. We thought, how does this apply to your retirement distribution plan? That's the wrong question, I think. The question is, where's your capital, and is it idle or is it invested? Is it productive or is it haphazard? And I think when we have the opportunity to ask those questions and challenge the current state and say, hey, yeah, absolutely, it belongs there. This is why it's here. Let's double down. That's the conversation clients really want to have: an intentional management of capital allocation, regardless of currency and regardless of language, because that's universal for all of us in a capitalistic society. And I think that's why we started there. And that's a little departure for sure, but not for ultra high net worth. That's the question they've been trying to answer forever. And I think now that's available to mass market.
And I also think what you've done for advisors is the thing that we preach so much at Bonrian, which is, if you don't know what else your client's allocating capital to, then you're losing out the opportunity to be able to influence how they allocate that capital and potentially bring that capital to you do the allocations and to bill on. And, ultimately, the problem, then there's another problem, like, how do I bill on it? And that's what we set to kind of resolve here at Bonrian. But the point being is, if you don't know how all of their capital is being allocated, then you can't influence those capital decisions and potentially bring more assets into your business to help them make better decisions on how to allocate capital to those non-traditional markets. And I think a solution like what you have with Asset Map allows the advisor to have at least that conversation and to know what the actual net worth of their client is. Because I'm not convinced that most advisors actually do know the total net worth of their client because they don't ask those questions.
It's true. And actually, and I would just add on to that, it turns out that net worth doesn't matter. It's what capital that you control matters. I'll tell you, I could have a net worth of zero, but I got $100 million in trust because I did good planning. My net worth zero. And I want my net worth to be more than zero, but I want to control $100 million of capital. Like, in that distinction, or I want to control an endowment that has $2 billion in it, we have to ask a different question, which is how much influence you have over the capital and what's your responsibility for that capital? Is it cash flow? Is it growth? Is it tax management? Is it endowment? Is it legacy? Right. And then we can start asking a better question is, does this choice to have this money in XYZ direct investment match the overall strategy or not? And if it doesn't, goodbye. And that's what you're paying for. You're paying for intelligent management and thoughtfulness to say this serves you or it doesn't. And we can't answer that question if we don't have transparency. And that's the key is let's just throw it all on the bed and figure out what deserves to stay here and what can be fixed and filled.
No, I completely agree. And I wanted to thank you for joining us today. I appreciate all your time. I think the advisors that listen to this show might be a little surprised by the departure of like talking about the nitty-gritty of investments, but I thought that this was a good conversation to have because broadly speaking, the reason advisors listen to this show is because they want to stand out from their peers. They want to be able to service and support their clients in a superior way. And this really is part of that this is part of that conversation. So I want to thank you for your time. I know you're busy. It's great to have you. No. And I just want to say to our audience, thank you for joining us for this episode. Again, I'm Shana Orzik-Sitzel, the founder and CEO of Bondurant Capital Management. If you have any feedback on this episode or if there's something you want to hear about, please let us know. And don't forget to like and subscribe to What's the Alternative podcast, as well as Bondurant's other podcasts, The Alternative Mason and You're Doing It All Wrong. Thank you so much. Until next time. The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Bondurant Capital Management's platform. As such, Bondurant may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Bondurant Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Bondurant Capital trademarks mentioned are owned by Bondurant Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.